Hello, everybody. Firstly, I'd just like to welcome you to this webinar, where we'll be talking about the Bank of England monetary policy meeting and the potential trading opportunities that will come up as a result of the report. My name is Sasha, and I'm a financial analyst from the research department at Foretrade. I'm really pleased that more people are watching our webinars, and thanks for your kind comments. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. At this point, I'd just like to ask you not to click away until the end of the presentation, as we've got a special offer coming up that will significantly affect your trading experience. I'll also show you what we call a market opportunity in a practical way. So, in this webinar, we'll be talking about the Bank of England. The Bank of England is the second oldest central bank in the world and was privately owned by stockholders until it was nationalized in 1946. In 1998, it became an independent public organization. Stable prices and confidence in the currency are the two main criteria set by the government for the bank. Stable prices are kept in place by the bank, meeting the government's inflation target. As I said, the Bank of England was given independence from political control almost 20 years ago, and the right to set interest rates. We'll come back to this in a moment, since independence doesn't mean the bank isn't subject to pressure from political events. The bank became a monetary policy institute, with 9 members of its monetary policy committee setting interest rates. Although committee members are free to set interest rates according to their expertise, the British Treasury has reserved powers to give orders to the committee in the public interest and in extreme economic circumstances. Those 9 members of the MPC are tasked with getting as close as possible to the government's inflation target. Before its independence, officials in the Treasury who weren't independent of government set interest rates. It was thought that purely economic judgments on monetary policy would be superior to the decisions of politicians at the Treasury. The Bank of England has been accused of being politically partisan. Most recently, before, during, and after the referendum campaign on British membership of the European Union, Bank Governor Mark Carney was criticised by senior politicians and the media as being biased against Brexit. He was accused of abusing his function to support the Conservative government's pro-EU position at the time, in order to influence the referendum decision. It should be said that while it's true that Carney had warned that Brexit could hit the economy and cause instability, this was not an uncommon view among economists. And many of those economists would say that the current position of the UK economy shows that this view was correct. Carney rejected the accusation, saying his view represented the Bank of England, and that he had not come under any pressure from politicians to support one side or the other. It's an example of how the independence of institutions can come under political pressure, and this should also be taken into account when making trading decisions. The Monetary Policy Committee. The MPC is responsible for formulating the UK's monetary policy. Its committee meets 8 times a year to decide the interest rate and to direct the government's monetary policy. The committee has 9 members, including Governor Mark Carney. The main aim of the committee is to keep inflation close to the government's target of 2%. The secondary aim is to support the government's economic policies and help meet its targets for growth and employment. Apart from the setting of interest rates, the other main monetary policy measure used by the bank has been quantitative easing through its asset purchase facility. In plain English, QE is the Bank of England's printing money to buy government bonds. The idea is to boost the economy by increasing liquidity. The bank's QE program began in 2009, and until 2015, many economists argued that QE was a success story in the UK and credited the British economic recovery, at least partly, as being due to QE policy. Since the British economy has now stalled, economists are asking whether QE helped. In the second quarter of 2017, UK GDP growth remained at 0.3%, the same figure as first quarter growth. This was 0.1% below the Bank of England's expectations, but in line with forecasts from economists. Inflation is still high at 2.6%, although July's figure was a welcome surprise to economists and closer to the central bank's target of 2%. The latest CPI inflation figure for August was announced today. It was 2.9% and slightly above expectations. However, the bank expects inflation to rise to 3% in October, so inflation will remain a problem. A rate hike could be a prospect at some point. With growth static, a rate hike is unlikely to happen this year, although some economists feel a hike is necessary sooner rather than later. I will return to this again in a moment. The unemployment rate is currently one of the few positive indicators at 4.4%. This is the lowest level of unemployment in the UK for over 40 years. However, there is debate about how positive this is on the overall economy, since wage growth remains low. Finally, on July the 24th, the IMF downgraded its UK annual growth forecast from 2% to 1.7%. So, what can we expect from the Monetary Policy Committee? Well, it's widely expected that rates will remain unchanged at 0.25%. The last time the interest rate changed was in August 2016, when the rate was cut from 0.5% to its current rate. It's important to look at how many members vote for a rate hike. At the last meeting in August, the bank voted 6-2 in favour of maintaining the current interest rate of 0.25%. Two members, Michael Saunders and Ian McCafferty, voted for an interest rate rise. Please note that there were only 8 MPC members since Deputy Governor Charlotte Hogg resigned earlier this year. To give you a concrete example of how important the MPC vote can be, we can look back to June's MPC meeting. Once it was announced that the MPC voted by a close 5-3 margin to maintain interest rates, the value of the pound climbed against a basket of other currencies. The published minutes of the MPC meeting also contained higher than predicted numbers for inflation, implying that an interest rate rise could occur more quickly than expected. By referring to the minutes, we can also see the positions that individual MPC members hold and what was discussed. For example, it was only once the minutes for June's meeting was published that we found out that inflation was expected to exceed 3% later this year. At the time, the market saw this and the MPC vote as a sign that interest rates would rise in the near future. Sometimes monetary policy members make their positions clear in the media or drop hints about how they will vote. On August the 31st, Michael Saunders, an external member of the Monetary Policy Committee, said it would be better if the central bank acts on interest rates sooner rather than later to offset rising inflation. He also warned against keeping monetary policy overly loose and claimed that estimates of weak economic growth might be pessimistic. Earlier this year, the bank's chief economist, Andy Haldane, who also has voting rights on the committee, publicly called for a rate rise relatively soon. even though he has voted to maintain interest rates at their current rate levels until now. Despite some differences of opinion within the committee and considerable interest as to whether Haldane will turn into a hawk and support a rise, no interest rate rise is expected from the MPC this month. It goes without saying that the most important member of the committee, Government Carney's speeches or statements to the media are most closely watched and reacted to by the markets. In June, the bank governor stated in his Mansion House speech that now is not yet the time to start raising rates. And then the value of the pound dropped to a 2-month low immediately afterward. So, what are the chances of an interest rate raise in the short term? Well, most analysts don't believe that there will be a hike this year, although some believe there is a chance of a small rise before the end of the year. The hawks feel that the weakness of the pound will cause the MPC to act to encourage a downward trend in inflation. On the other hand, the slight recovery in the value of the pound in recent days has weakened this argument. Many economists don't believe it likely that the UK will raise rates, at least until an agreement is reached with the European Union on Brexit. As discussed, the British economy isn't strong at the moment. The most recent indicators such as construction PMI and service PMI show that the economy is still performing below expectations. Even lifting rates might decrease economic activity further. However, the latest inflation figure will put additional pressure to raise rates, and a rate rise cannot be ruled out before the end of the year. How is the British economy underperforming? Economic analysts point to 3 factors in order of consensus: weak productivity, low wage growth, and not enough investment. Why these factors are a particular issue in the British economy is a matter of economic and political debate. However, this doesn't mean that there aren't good opportunities to be had trading on UK companies and the British pound. It's likely that at some point both the pound and the economy will recover. The question is when. So what does this mean for those of us who trade in Forex? Well, in the short term, with no serious prospect of a rise in interest rates, many analysts believe the currency might further weaken over the coming months. Brexit generally remains a negative influence upon indicators and the markets. But the main issue now is that analysts believe that in order for the pound to rally, the markets will need to see a concrete trade agreement with the European Union in discussions that are currently ongoing. In current political circumstances, this seems unlikely in the short term. For now, the British political class does not have a united vision of what kind of Brexit they want. However, positive economic news for the UK in terms of economic growth and other indicators may bring forward the possible date for a rate hike, which could lead to a slight recovery in the price of the pound. A higher inflation rate does nevertheless put pressure on the bank to increase rates, and following the announcement of today's figure, the value of the pound grew sharply, as hopes among traders grew that this would happen. Those traders are speculating that the Bank of England may feel it has no choice but to raise rates to lessen inflationary pressure, since an inflation rate higher than 3% might cause the markets to lose more confidence in the UK economy. Analysts agree that a trade agreement with the EU is hugely important to reverse the fortunes of the British pound and to regain the confidence of the markets. Many traders believe that if such an agreement is made, the pound will rally. This prospect still seems some time away. So, on to market opportunities. As you might know, market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical analysis, and technical analysis that you can see on the right-hand side of the screen. This section contains the pivot point, which is the recommended price for opening a trading position. What you can see in front of you is a sample of a market opportunity. Support and resistance levels for daily, weekly, or monthly terms, and finally profit or loss calculations here are based on a one-lot trading volume. And now for our special offer. If you make a deposit within the next 48 hours, you can receive a balance bonus. If you deposit 1,000 euros, you will receive a 2% balance bonus. If you deposit 2,500 euros, you will receive a 4% balance bonus on a second time deposit. Deposit 5,000 euros and receive a 5% balance bonus on a second time deposit. Deposit from 5,000 to 15,000 euros and your overnight interest rate will be covered for 1 month. Deposit 15,000 to 25,000 and your overnight interest rate will be covered for 2 months. Deposit 25,000 or more and your interest rate will be covered for 3 months. Of course, we at Foretrade will be following developments that affect the markets very closely. So please do get in touch with the senior account manager if you have any questions or want to take advantage of the trading opportunities that this event is certain to present. Our next webinar will be on September the 18th about the Fed's interest rate decision. It's another very important event in the economic calendar, likely to have an impact upon your trading decisions. So please sign up for that webinar, as we aim to give you the very best quality analysis out there. I hope you enjoyed this presentation. I and the rest of the research team will continue to follow developments in the UK and elsewhere closely. Until next time, goodbye, and please join us again at Foretrade soon.